All right. All right. Welcome, everybody. I know many of you have been anxiously awaiting to learn about all these great small business administration opportunities that are there for your business, or determine if they're great for your business, for that matter. And we are excited to have with us today Mark Costello, who's the Deputy Director for the U.S. Small Business Administration. And joining us shortly will be the National Restaurant Association's Director of Tax Policy, and the one who worked directly on the bill is working with the agency on rulemaking, Aaron Frazier. In fact, it looks like Aaron's been able to join us. Aaron, can you hear us? I'm guessing you're going to be coming in a minute. And we'll be walking through kind of this whirlwind of opportunity that's come up over the past week in these different small business administration loan opportunities. Mark, can you hear me okay?
I can hear you. Thanks, Anthony.
Welcome. And Aaron, can you hear us all right? All right, we're still working on Aaron's audio, but that is not going to slow us down. As we go, as we have questions, please type them into chat. Joe Bushnell, who has been one of our team here in Washington and been trying to track all this activities going on, is going to be tracking your questions in chat and then dropping them into the right area as we go. So Pamela already has a question, and Joe will be tracking those. And as we get to the different sections of our presentation, we'll ask him, are there any questions from our live audience? We did get over 100 questions in prior to this to pepper Mark and Aaron with. Some will know, some we won't, but we will do everything we can to be the best resource we can. With that being said, I'm going to say hi, Aaron. Any chance you're hearing us yet? Okay, we're still working on Aaron there. With that, I think that's okay, because Mark, you are going to kick us off, and there's so much going on between new acronyms like EIDL and PPP and PPL. Can you let us know, can you give us just the 30-second elevator speech on the opportunities that are there for us? And Lex, while he does, I think he'd like to bring up the SBA site to show our listeners, our watchers, to kind of work.
Can you hear me?
Hey, Aaron, welcome.
Hey there. Yeah, thank you.
Absolutely, I'm excited you could be here with us.
Your team is great. Thanks for all their help.
Well, you guys have done a great job of at the National Restaurant Association in working for our industry. So we thank you very much. With that, Mark, go ahead and on our first our opening, just give us the basics. Let's have you scroll down a little bit. I think you'll see.
Absolutely.
There you go.
Absolutely. Hey, thanks, Anthony, and thanks to everybody who's joined us today. This is a really a nice opportunity in a difficult time. It's a nice opportunity for me to be able to connect with you guys and hopefully share some information and some resources that are going to be helpful and useful for you as we all kind of work to get through this very unique and unprecedented economic interruption that we're facing right now. I want to thank Anthony. He's been working diligently on putting this together and has come up with a variety of really good points and questions that hopefully we're going to be able to flesh out as we follow through on our conversation today. Just as Anthony suggested, SBA has taken kind of a point position with regard to providing some programs that are going to be of benefit to small businesses in addressing this economic interruption. Specifically, and these are a couple that we're going to delve into. We started out by introducing what we call the Economic Injury Disaster Loan Program. This is a direct loan product. These are loans made directly by SBA, loans up to as much as $2 million, fixed interest rate 3.75. And these loans are going to be termed out over either 15 or 30 years. The intent of this program is to cover operating costs that are going to be incurred over the next 6 months. And so really looking forward now, you would probably be considering out until October, and having a source of funding to cover not only payroll, but also other kinds of operating expenses, such as lease payments or even fixed debt payments that you might be incurring. This is a no-fee program directly available from SBA. We've recently updated our application portal such that it literally only takes about 10 minutes to apply for this program. Another nice, unique feature that has been built into the program as part of the CARES Act. In fact, $1 billion was carved out of the CARES Act to cover the cost of this $10,000 advance that you guys can see up on the screen. So when we re-implemented or redeveloped the portal, it made the process way easier. Like I said, 5 to 10 minutes. I went through it myself to apply for one of these loans. And at the end of the application process, you're going to be asked if you would like up to a $10,000 quick cash advance. And so naturally, you're probably going to say yes, because what you're going to find is that that is money. It's dictated based on your employee level. Basically $1,000 per employee, but it doesn't have to be repaid. So that in effect is a grant that hopefully would provide some immediate benefit while the economic injury disaster loan is being closed and ultimately dispersed. As I said, again, this is a 6-month window to cover your costs, to hopefully allow you guys to maintain operations and be in a good, strong position at such time as things start to return to a normal economic footing, that you're going to be able to launch, and you're going to be able to retain your employees and have your operating costs covered at that time. So that was the first program, or first tool, if you will, that SBA introduced. The second, and I suppose more noteworthy, because it's the current program that everybody seems to be interested in and talking about, really from the top down. It's been a significant topic of conversation in Washington, D.C. with the president and so on, and primarily driven by the recent CARES Act legislative package that he passed or signed here about just a little over a week ago. And within that is this tool. It's the first one on the left there that Anthony has been nice enough to pull up our web page. It's the Paycheck Protection Program. That gets hard to say when you repeat it a number of different times. Sometimes they just call it the PPP. In any case, you guys, this is a companion program to the economic injury disaster loan. So the economic injury disaster loan, as I said, really is intended to bridge businesses until we get to a point of normalcy in the economy. The Paycheck Protection Program is intended to kind of do the same thing, but it has a significant orientation toward payroll and employee retention. And ultimately, the compelling feature of the Paycheck Protection Program that I think everybody's going to want to at least take a look at is the forgivability aspect of this money. And what I mean by that, go ahead, Anthony.
And Mark, I do want to get into that. I kind of want to give everyone kind of the initial overview, and I think you did a great job at that. If you're okay, let's just break down the Paycheck Protection.
Let's do it.
A little bit. And as Lex is catching the slides up, but talk to us about eligibility.
Absolutely.
Let's start with the eligibility. No, Lex, you got to go backwards. There you go. One more. Back one more. There we go. Who is eligible for for the Paycheck Protection Program?
So it's interesting, Anthony, because the program is being made available to a wide array of entities. Just to give you a little context to that statement, typically SBA loans are not available to nonprofit organizations, but they are in this case. So what SBA would consider to be a small business is going to be eligible, and any business with 500 or fewer employees is going to be eligible. So we've actually broadened out our applicability of size determinations or size standards. So it suffice it to say that a rather large business could conceivably be eligible for this program. One of the nice things I think about if it ever made sense for an owner of a large chain of restaurants, for example, the 500 employee limitation is per unit. So it's conceivable that, again, a rather large organization could conceivably benefit from this program. Other eligibility criteria, they're very limited. Ultimately, what we're talking about here is loans that have a maximum amount of $10 million, which is twice what the typical SBA standard is. And the mechanics of the program are going to be that essentially, as I said, anybody who is defined as a small business or is a nonprofit organization is going to qualify for the program.
Okay. We got a couple of questions. Let's go back to our slide from our members around eligibility. And the first one I've got is, what if I just opened a restaurant recently or in the past quarter or so? Am I still eligible for this loan?
Yeah, and this is a question that we certainly have been fielding since the discussion of this program began. And what I would say is that if you have any evidence of payroll having been incurred, payroll costs or expenses having been incurred, that there could be a way to qualify for the Paycheck Protection Program. What I would also say, though, and this is why I think it's important to look at both of these products at the same time, is that somebody like that may be able to derive more benefit from the economic injury disaster loan product because they could forecast out what some of those other operating costs are or are going to be, even if they've maybe just recently signed a lease or just recently purchased equipment and maybe don't have a lot of people on payroll yet. It's possible that they could get financial benefit and relief through the economic injury disaster loan, whereas their limitation of payroll data or history might impact their ability to optimize the Paycheck Protection Program.
Okay. Well, I think that answered the question. So what I heard is even if you're a new restaurant, you still might have options here, but you really should talk to your lender, your banking relationship on if, because you're new, this makes more sense. And if you flip to the next one, Lex, or if some of the other SBA options might be better for you.
Yeah, absolutely. And I think it's important to talk about a couple things on that economic injury disaster loan, Anthony. While it's a loan with that potential forgiveness piece up front, it's a loan that's going to be programmed out for a pretty extensive period of time, as I said, either 15 or 30 years, and it has a 12-month built-in deferment feature. So in other words, that once you get the loan proceeds, you're not going to have to start amortizing that debt for a year.
Okay. Aaron, you've been working with the National Restaurant Association and on the Hill in live time. Is there a sense for newer operators on what might, from a design standpoint, be a better option? Or really, is it just have the conversation with your vendors and learn what's right for you?
Yeah, echoing Mark's points that this is a unique feature of the legislation. And it is one that is aimed at small businesses that need cash flow, but so are things like the economic injury disaster loans. So are things like the employee retention tax credit. and even the payroll tax holiday. We will say that the PPP, because of its uniqueness, it doesn't always align with other features of the bill. For example, when the PPP and the EIDL, the EIDL, when those are both used, they cannot be used under the same time or the same purpose. They need to be sequenced in a way that they are not actually intersecting within the business on your payroll or in the time period. So there are some key features that need to be weighed with your accountant, with whoever does your books, your lender. All those things are extremely important. And then also looking at where's the path to employee retention vis-a-vis the opening of your business and operations. I think those are all things that we're going to have to make some imperfect calculations on, because as much as we want to boil this down to a science, it's a little bit of an art when you look at what our summer is going to look like, let alone May.
Well, I think you both kind of answered the question, but if there's an easy way to say yes or no, if someone gets an EIDL, does that eliminate them from getting the PPP? Which I'm not used to saying that many letters at the same time.
Yeah.
Do they eliminate, or is it just, as Aaron said, a matter of sequencing so they're not at the same time?
Right. Yeah, Aaron's point was great. If somebody has an EIDL application pending right now, Anthony, it can actually be refinanced into the PPP. The key here is to understand what Aaron mentioned, is that these proceeds or funds cannot be used for the same purpose. And so the PPP, we would anticipate is going to be used, to a great extent for payroll over the next 8 weeks, in fact. Whereas the EIDL can contemplate a longer horizon, out 6 months, as I mentioned. And so other operating costs would be easier to put into that, as well as longer term working capital. And I think that's important too, that while the PPP, or maybe that upfront $10,000 cash grant that might be available, are going to meet those shorter term needs, I think people might have an opportunity to position themselves a little bit more strongly financially in considering both products. What I mean by that is after 8 weeks or 10 weeks or whatever, and maybe things do start to return to normalcy, there's an opportunity to have a bolstered level of working capital as a result of the economic injury disaster product, and to use that to effectively relaunch the business. So not only will you be able to have the employees back and on the payroll, but you would also potentially have some liquidity to contemplate things like, how are we going to get the word out? How are we going to relaunch this thing in terms of our marketing efforts?
Okay, I think that really, you can be, at the end of the day, everyone's going to have different options that's right for their business. But what I'm hearing from both of you is there is a chance to use both of these to be strategic with how you get yourself relaunched.
I think that's a great way to put it.
Okay, and I think that's great, because I think initially the myth was if you got one, you couldn't do the other. So I think you've helped us dispel that. Thank you both, Mark and Aaron. The question that we've gotten is, how much loss do I have to demonstrate in order to be eligible? Do I have to demonstrate any loss to be eligible for the PPP?
Right. And I'll let Aaron chime in here. I'll throw in my 2 cents worth on this, Anthony. So this is an interesting product. The onus for a lot of the validation or verification is in the application document that the small business is actually going to sign. And they're going to attest to certain things. And I believe that within that is going to be some kind of a statement or a certification that they have in fact suffered some type of business or financial impairment or impact as a result of this COVID-19 crisis. that will suffice from the standpoint of the lender, what the lender needs to see, what they need to know. Now, having said that, I think that the important thing is there may be some businesses out there that are not being impacted for whatever reason. And the reality of it is hey, good for them. They shouldn't be pursuing this money. You know, what financial impact or impairment exactly looks like, how to quantify it. We're not really going to go into that too much. So we're kind of relying on folks to certify to that effect, and trusting in that process.
Okay. So, Aaron, any different advice on that one? Oh, go back to the previous one.
Yeah, I think in my perspective, they have economic disruption. I think that's something for the PPP loan, that they want to tell you that something has changed through the economics of your business, that it will trigger the need for a PPP loan. Now, as you know, like if you're a grocery store or if you're selling masks, yeah, your economies have changed dramatically, but they've changed for the good. Maybe they want you to scale up production of masks or antivirals or something. So in some ways, you know, it wasn't as prescriptive as we wanted to in the legislation. I mean, I'm not going to speak for SBA or Treasury because they don't want me to, and they shouldn't. But there isn't that mechanism of saying like, hey, what percentage actually qualifies you for the PPP loan. Now, the important thing to remember is that there is exemption authority, de minimis exemption authority under the CARES Act that would allow Treasury and SBA administrator, the Treasury Secretary and the SBA administrator. Sorry, I have a 1-year-old. That would allow them to exempt people from loan forgiveness reduction, and that's something we're going to build on more in comments this week.
Okay. Well, and what's your 1-year-old's name, Aaron?
What was that again?
What was your 1-year-old's name? What is your 1-year-old?
My 1-year-old's name is Luke. I just turned 1 last month, and he's doing well. But
right.
you know, he's not the best.
It sounds like he likes ambiguity as much as the rest of us. So, Luke, welcome to the call. I want to go to the bottom line on that one is there's no set percentage. Demonstrate at this point, demonstrate an impact and submit it. And if we learn more later, we'll learn more later. But at this time, don't worry about a percentage. This was an interesting one I got from a couple of tavern pull tab that happen to have pull tabs.
Yeah.
Is there anything, if you have pull tabs, even if it's minimus gaming, that would pull you out of the either one of these loan processes? Yeah.
Hey, Anthony, this actually came up on something that was shared this morning with one of our attorneys. Certain aspects of the traditional eligibility framework for SBA loans have been set aside for the purposes of the PPP. However, others have not, and this is one that continues to exist as an eligibility criteria that needs to be met. And so just for those that may or may not have ever come across this, the basic idea for a business that has any kind of a gambling component is that the gross proceeds from that piece of the business are not to exceed 1/3. So in the case of the tavern with pull tabs, we're talking about, you know, what are they going to net out of that, and whether or not that constitutes, you know, more than 33% of the gross revenue of the business. If it does, the business would not be eligible for this program.
So whether we like the answer or not, the answer, what I heard you say, Mark, is that if 1/3 of your revenue comes from pull tabs or more, you're not eligible.
Correct.
Is it net or gross? Can it be gross? Because a restaurant, a tavern's P&L is really mixed in with a lot of things. It's you don't calculate a net on every item per se.
Sure, it's the net revenue from the pull tabs, right? However,
Gotcha. So the net revenue from the pull tabs can't be more than 1/3 of the
exactly.
Okay. All right. Thank you for that. I'm going to skip the next one because we spent a lot of time on eligibility. Joe, what I'd love for you to do is skip that one for now. Collect all the eligibility questions, Joe, and at the end, time permitting, we'll try to go through section by section and do some of those. Does that sound okay, Joe?
Roger that.
Okay. General questions on timing, and just general before we get too specific on some of the big questions I know we have. Once they apply for an SBA loan, Mark, what's the anticipation time before on the PPP before they might be able to get a check?
You know, that's a great question, Anthony, and I think it's no secret that both of these programs are being implemented with sort of optimal speed in mind, optimal efficiency in the process. So having said that, my understanding is that really we're talking about something in the 5 to 7 day range for receipt of funds through the Paycheck Protection Program. And this is the banking community working with SBA and Treasury ultimately to drive the transfer of funds and make that happen and get those into the customer's account within that period of time. Having said all of that, we know that there's a ramp up going on in some cases. A couple of large lenders, I believe, have gotten quite active with the program already. We have other lenders that are just getting going on their sort of queue of customers that they're trying to work through. We have other lenders that are just getting hooked up to the SBA system so that they're going to be able to participate in the program as well. So people do need to be realistic about that understand that it may add some time to the process because these lenders are working through backlogs already. However, ultimately, when they get to the point of submitting the application, receipt of funds should not be more than a few days after that.
Okay.
And
so
I don't know
if it's on a simplistic side, Mark, is work with your vendor. They're all going as fast as they can, but at different paces.
That's exactly right.
But the system is built to get the money to as fast as we can.
Absolutely.
But don't count on that. It really should be the conversation with your bank lending relationship.
That's exactly right.
Which kind of gets me to my next question. If you can click on next there, Lex. Lex is our comm director and is serving as my slide manager. Appreciate it, Lex. Is this a first come, first serve scenario for the loan? We saw, and Aaron, I think I'm going to have you go this one first, and then Mark, please correct. We saw that Wells Fargo announced that they've already taken as many of these loans as they intend to. Or they're allotted. I didn't quite understand the press release. How important it is that people get on this now and get their application in this week? Aaron?
Hey, Anthony, and that's really a key question, because I think as we look at the Paycheck Protection Program, the amount of interest in this program just since Friday, it's really amazing, but it's also an indication of how important and how critical cash on hand liquidity is right now, not a week from now or a month from now, right now. So in Treasury's regulations and their guidance, they do use the term first come, first serve. So I suspect that's where that line came from for Anthony's slides, which means for us, we think, oh my God, this money's going to go really, really quick. And we don't want people who apply in late April, early May to be on the outside looking in of this program. So I do think it's extremely important to get familiar with the SBA 7A program as soon as possible. It is very important to talk to your lender and find a lender who does SBA loans, who's familiar with it, and that you're comfortable with it, to have those conversations about what it looks like for your business and what it looks like through the bank and when the money could actually arrive. The third component of that is the political pressure that we are trying to ramp up. We're writing a letter right now because we've heard that the Speaker and the White House, folks who don't normally get along great, are in alignment on saying, yeah, the PPP needs to be both extended and replenished with some of the funding, because currently that set aside amount of $349 billion is going like 99-cent beer night at my college. Like it's going quick. So we are really focusing on the political pressure saying we need this funding. We need it set aside for particularly impacted industries like restaurants and hotels. So we are continuing to drive that message, but overall, there is an understanding in DC that this funding needs to be replenished, deepened, and ultimately extended. And we're going to be working on what that looks like as of this hour and the past 2 hours. I don't know if Mark has any further or better insight on what he's seen and heard from over the past few days. I would be extremely interested in that.
Yeah. Hey, thank you. As you guys can imagine, that's a question that folks have, and so sometimes our guidance of hey, have a little patience, and lenders are trying to get up to speed and all of that doesn't necessarily correlate very well with the idea that the money is being lent very quickly. So yeah, I guess I've heard the same kinds of things. I'm obviously not a political, that's not my role, having to do with the ability to replenish this fund depending on how quickly the money is expended. For now, our message is people need to be thoughtful, but they also need to be aware of the way that this funding can be accessed, and first and foremost is really the idea of, if you have a lending relationship, do make every effort to be in communication with that lender, determine whether or not they in fact are going to be offering or are offering the Paycheck Protection Program. If they are, then that's a beautiful resource for you guys, and they're going to have some of the security things and the information that they need to make the process a bit easier. If it turns out that either you don't have a banking relationship or your lender is not offering the Paycheck Protection Program, I think it's important to be out kind of doing some due diligence to determine which lenders are willing to take on non-customer clients. And there are some. We're trying to compile some of that information, Anthony, right now as we speak. I can tell you that I think you and I might have talked about this. Washington Federal and Washington Trust have both indicated that they're going to be willing and able to entertain PPP loans for non-bank customers. They're going to be more, and I think a lot of times it's going to be a matter of making the phone calls, checking the websites, shooting the emails out to get a connection. But there are definitely some, I guess what you might call community-minded lending organizations out there that will want to help you in this effort. Again, be mindful and aware of the fact that, yeah, they might have a queue of their own customers that they're working through, but get on their list, get in their queue, and I'm confident that at the end of the day, there's going to be funding for you.
So thank you for that. Mark, I know there's going to be a series of questions that we just don't know the answer for, but for Ian, who's recording our follow-up questions, maybe if as you develop a list of banks who are willing to do this with customers they've not had before, if you can share that list up, and we'll get that link out to our members. I want to move along because we did ask you to be for about an hour, and I think we're going to go long, but I don't want to be too much longer than what I asked you for, Mark. I think this is the simple question that we get a lot of: how much am I eligible for, and how was the loan calculated exactly? Just for simplicity's sake, Mark and Aaron and I, penciled out this. Oh, look, it doesn't come up on the PowerPoint. It flies in. If you're a restaurant that's got about $500,000 in labor cost, and you don't have any employees whose compensation exceed $100,000, and you have about $75,000 in payroll and income taxes, the way this is structured is generally it's going to say your adjusted labor cost, annual labor costs, is $425,000. If you divide that by 12 months, you get your average payroll cost, adjusted payroll cost for the PPP per month. And if you times that by 2.5 times, which is what the legislation calls for, your potential loan amount is about $104,161. About in this scenario. Mark, I'll start with Aaron. Aaron, does this generally look right? And as people are doing the back of the menu calculation, just to know what they're going to their bank for, anything in addition you'd ask them to think about in trying to determine what they might be eligible for?
Yeah, folks only knew what I got in grades in math in college. But I'll tell you what, it does look right, and really what, and I'll just focus in on that average monthly payroll cost for PPP. That can go back 12 months from the loan origination date. But Treasury's asking you to do it for 2019 just because it's a little bit easier to know what that looks like for your average monthly payroll costs. Additionally, for seasonal operators, which we know are a ton in our industry, you can use a similar time period from February 15th until June 30th of 2019. So you can take a slice of time as a seasonal operator, what you're used to be seeing in terms of revenue during that time, and what you usually have for FTEs during that time period. If you're in a ski town or you're by the coast, I think that makes sense to people in this industry. And the second thing that I'd really highlight for people, and this is also something that we've seen in Treasury guidance, that when you get that PPP loan amount for this example that Anthony and his team have designed, 75% of that 104 needs to go to payroll costs in order to achieve loan forgiveness. And that's a big amount. I mean, if you're
and Aaron, we're going to come back to loan forgiveness in a minute, because I think once we open up that can, the chat room is going to light up. But I think you're right, and we'll get into the 75% in a minute. Mark, I want to save you if you're okay, unless you have any red flags with this for some of the questions we have in this area.
No, that sounds great. I appreciate Aaron's the way that he laid that out.
Okay. And Aaron or Mark, just jump in. What if I didn't own this restaurant last year? Can I use the payroll hours from a different from this time period from the different owner?
I would say yes. Aaron, what do you think? And the reason I say that, Anthony, is because it's a payroll-driven program, and so I think the idea is that the focus is on payroll, not necessarily on ownership. And so if the ownership happened to change, so be it. If the records are there to substantiate that average payroll, and we have a new operator in place, I have no. I'm thinking that there's no impediment to that person being able to apply for the program.
Aaron, any counter advice? I think it's going to depend on the relationship you have with your bank, but any counter advice, Aaron?
I've seen for that. No, that all sounds right to me in terms of if it's a change of ownership, then just take the previously operating ownership's FTE and FTE payrolls. But as a if you just open up a restaurant at the beginning of the year, then you take January and February. They're saying, okay, give us your salary history, as it were, for January and February as we calculate what we would expect for March, April, May, June. So that's been in the bill that I've seen, if it's a new business altogether. Okay.
You just mentioned FTEs, and initially there's a lot of conversation about the FTE calculation was going to be important for this loan. Did that pan out to be true in the rulemaking? do we need to know how an FTE is defined for this loan and how that works? Mark?
My take on it, Anthony, was that was a discussion underway, but it strikes me that really what we're talking about is the payroll dollars on a monthly basis. And I'm not quite sure how that necessarily has to tie into full-time equivalents or numbers of employees. I'd be curious to hear what Aaron thinks.
Aaron, how do you see this playing out? Was FTE an early conversation, but now it's really down to payroll dollars spent?
Yeah, but between you, me, and our best friends in Washington State, we've had conversations with the regulatory bodies in DC, and they've told us that they're writing it down. When we've asked, hey, it's actually a big deal for restaurants. Do we do the full-time equivalency? Because in the legislation, it says full-time equivalent employees. Later on in the legislation, not in the PPP program, but later on in the legislation, they refer to the calculation that employers would make to determine a full-time eligible employee of 30 hours a week. They go back to the ACA IRS definition of what a full-time equivalent employee is. They do not specify that in the PPP section. So for us, we've said, best guidance that we can give is use the 30 hours a week calculation. That was something that the drafters, the staff assumed. They kind of said, yeah, like we think it's the ACA definition versus the FLSA, Fair Labor Standards Act definition of 40 hours a week is full-time. So for us, we're saying, okay, like we have to be able to capture the universe. We don't want to leave people on the hook if they don't do 32 hours and they just go for all their 40-hour employees. So what we've been advising informally is use the 30-hour a week calculation that you're used to under the ACA. And if we need to alter that, we need to alter that. But we've asked, we have those asks in to Treasury, and we're anxiously awaiting confirmation on that point.
So Ian, this is one I'm going to want to bookmark. Ian's our staff that's doing our follow-up. We heard two different ideas from our panelists. And I think the reality is on some of our questions, as Mitch, it's going to make me pull my receding hairline out. We don't know all the answers today. And I think this is one, what you heard Aaron say is, at this point, there's no rules out there that would say you need to have X number of FTEs for this loan. And of what we know, it's mostly payroll. But that doesn't mean these rules aren't going to develop as we go. Is that a fair statement to both of you?
Absolutely, Anthony.
Okay.
Yes. We're going to be working on this for months, even after the program ends.
So team, I know you want some specifics on this and the couple hundred people we have on the phone. I think at this point in time, the best we can tell you is it's just payroll, but it doesn't mean that won't change as Treasury develops rules. So stay in contact with us. And the second they say differently, we'll let everyone know. So that there's a handful of FTE and hours questions. But my guess is if we don't know the first answer, Aaron, unless you think the answer would be different for this one, should I skip it at this time?
Yeah, I think honestly in the PPP program, I don't believe that there is a requirement to maintain part-time or seasonal employees in order to achieve the loan forgiveness. So in terms of the loan forgiveness, then that's that needs to be considered.
Okay. This should have been in the forgiveness section. Sorry, it jumped ahead here. I don't know how that did that. I'm going to come back to this question, but in the calculation of the, I'm going to skip both of these till we get to forgiveness. Well, I guess this would have to do with the loan. In qualifying for the loan and how much you can get, are all payroll taxes exempt from the loan number. So if you go back to my original slide here, sorry, gang, this is clearly here. I say minus payroll and income taxes. Are all payroll taxes to be taken out of that number? Aaron, do you know?
Yeah, I'm here. So Treasury actually just released guidance on this last night. I was literally trying to pull it up here. So payroll taxes, yeah. You know what? I'm gonna have to share the guidance on this, and I'll do that in the chat function that people have been using, because it gets into a little bit of complicated on FICA and on the existing employer, what the employer can withhold.
So let's do this, Aaron. Ian, let's mark that another one as a follow-up question, and then we'll let Aaron and Mark work with us to follow up on the detail of that. I think the same question was then going to follow up. Are all benefits able to include in your labor cost? Are there any benefits that we have to exclude from our labor cost?
The benefits you can include are group healthcare benefits. You can include your retirement benefits, family, vacation, medical leave. That is not included under the Families First coronavirus tax credits. So you can't include the Families First tax credits, but all other vacation, family, and medical leave you can include. Separation pay you can include, and retirement benefits you can include.
Okay.
I'm glad Aaron's on.
Hey, you guys are a good team, and we appreciate you trying to answer questions that we don't have all the answers to yet.
Mark, we have 49 webinars lined up after this, so I'm glad that we got you first.
You're going to be sharp.
This is a kind of on an eligibility issue. Mark, I'm going to let you read this one because I think this gets to our earlier conversation. If they're a closed company, are they eligible for the PPP?
Yeah, so that's a great question, and so my understanding, Anthony, of kind of the basic idea behind this program is to allow companies to be positioned to re-engage when the time is appropriate, to reopen and arm the business so that they're ready to do so. So even if, like a restaurant or other kinds of businesses that have been, essentially mandatorily closed, they're still qualified. The status, the operating status of the business itself does not preclude them from being able to access this program.
Okay. It's really the ability to distribute payroll, correct?
It really is. It really is.
Which I think feeds into the next question, because the reason this is so attractive versus the EIDL is because of the ability to forgive costs.
Right.
And so, again, trying to go with just simple math for a simple man, I'm going to go back to that. If you had $500,000 in payroll, roughly, you'd be eligible for $104,000 in PPP loan amounts. I got to say triple P or something. That's killing me.
P3.
There you go. And then you're eligible to get it all forgiven, but you're required to spend 75% of that on payroll. Aaron, is that generally right? That all of this is eligible to be forgiven, but you have to spend 75% of the loan on payroll. Is that an accurate statement?
That's an accurate statement. That the business would receive that $104,000 PPP loan. But if you wanted to get forgiven, there are a couple of other stipulations on there that I think we'll get to. But right away, you got to earmark 75% of that strictly for payroll cost.
Okay. And then the other parts you can be forgiven for outside of payroll that would be in that other 25% are things such as loan, things such as rent. Mark, what are some of the other examples?
Utilities, any of the sort of ongoing fixed costs that a business might incur. And then they talk about interest on existing indebtedness.
Okay. So this really gets to the question that people have been waiting for 50 minutes to ask, which is the big question. And I don't want to read that to you, but at the end of the day, most of our restaurants are closed or have significantly less payroll. We don't know when the 8 weeks, we know that June 30th is currently what's on the books for the last week of payroll that you can use. I'm going to start with the timing of the conversation. If you're not open by June 1 and this program runs out on June 30th, is this will this program still work for you? And how could this work? I'm going to start with you, Mark.
So I think it probably gets a little bit to the idea of what's the best option for the business and maybe the best option for the employees when looking at the idea of taking a paycheck protection loan versus the employee taking possibly the enhanced unemployment. So that's a decision that obviously needs to be made by all the parties. But the fundamental idea and the hope with this program, as I understood it, was that it would allow the business owner to pull those employees back if they have in fact been laid off and bring them back onto the payroll. If we get to the end of that time frame and we have not returned to that, what I guess I have been calling sort of a state of normalization in terms of the economy, the business is not going to be penalized for that. Our hope would be, I think, based on the discussion that has already taken place, would be that there would be additional opportunities for the business to seek bridge funding to get to the end of this deal. But if they haven't been able to reopen through no fault of their own, and they did pull their employees back or otherwise continued to pay existing employees with PPP funds, I think that's not going to be an issue.
And Mark, I think I want you, for most hotels and restaurant operators on the phone who literally live and die by labor cost. So you and I are about to embark on a conversation that's going to cause my dad to spin around up in heaven somewhere and say, why is my kid even talking like this? You and I talked yesterday that, look, if you're closed, you can still bring people off unemployment and pay them. They don't have to work per se. The idea is they'll get more from paychecks from you. They'll get more from than they would on unemployment insurance, and you'd still be able to be forgiven for this part of.
Yes, absolutely.
And then you'd still be eligible for that other 25%. So can you walk us through that conversation a little bit?
Yeah. I think again, the idea here is two things. One is the hope that it's going to allow the employer to maintain their organization intact, so that at the end of the crisis, they're going to have their operation ready to roll in terms of the human resource aspect, as opposed to having to go back out at the end of this and hire and seek replacements and train and all those different things, this is something that would hopefully preclude that kind of a situation. But also, yeah, I know it seems weird that you would maybe bring somebody back off of unemployment and pay them to not work, or that you would have a staff already that's not working and you'd be able to continue to pay them. But the alternative is unemployment and the benefits that might come from that. But I think we need to understand that this is unlike anything else that we've ever encountered. And these closures and this business interruption was not the fault of the business owners. So I think people need to get past any issues or concerns related to, hey, I'm not going to pay somebody for not working. That's not what this is about. This is about dealing with an urgent situation right now that in a way that hopefully is going to facilitate a effective restart of all of these businesses when the time comes.
And not surprisingly, this has got the chat room going with our most questions so far. So I want to get through some of the questions, but generally speaking, is there a way to apply for the loan, but not start paying people like today, but then not start the payroll until May 5th?
Right. So I got that question earlier today from somebody else too, Anthony. No, the idea is right now. So in other words, it's not, hey, I'm probably not gonna bring people back until, sometime in May. I'll start paying them then. The idea is to start paying them right now. Now, that's not to say that couldn't happen, but it will impact the forgiveness of the loan.
So, from your understanding of the loan, to be forgiven for the payroll, you have to start the payroll piece when you're approved and eligible.
And the loan is dispersed, yeah, which should be shortly after the approval.
So that's where the strategic question really comes in for operators is, one, what's the value of me waiting a week or two so I'm getting closer to a likely payroll period versus but I'm risking the money not being there versus applying today, but I don't have anyone to hire and my restaurant is flat out closed.
Right. No, that's a great point. So they're kind of both options. Yeah.
Aaron, any different take? And it's okay to say no or we don't know yet, but any different take than the dialogue that Mark and I just had?
Well, I think that's it's a fundamental question. It's one we've had over and over because originally we thought that it was locked in when a business was awarded the PPP loan. They get awarded the loan and then they choose their 8-week time period. When the loan today on April 7th, can you backdate it and say, okay, I want the 8-week period to start May 5th, leading up to June 30th, the end of the covered period? And whatever guidance we can have that would help that would be really, really helpful, period. Because we haven't got any.
So what I'm hearing, Ian, this is another one for follow-up questions as rules develop. What Mark is telling us from what we know today and what exists on the books today is you got to start your payroll when you're eligible to start spending from the loan. What Aaron is saying that we're working on rules clarification to see if we can get some flexibility on that. But the reality is we don't have it as we sit here in this moment. Is that as good as we're going to get from a clarity answer for the moment from the two of you?
Yes. Yeah, I think that sounds right, Anthony.
Aaron? Did we lose Aaron?
No, I'm here. Honestly, I think that's something that we're still trying to follow. We're still trying to get that clarity on, but unfortunately, we don't have any more direct guidance on that.
Okay. I'm going to go through a couple of these questions. I think we just talked about this one at length. I think a lot of these questions relate to this. What happens if I only have 6 weeks of payroll? Does that reduce my eligibility, or as long as I spend the payroll, I'm okay? Does that impact the percentage of forgiveness I have? Mark, starting with you.
In other words, that they only used the loan to pay 6 weeks rather than 8 weeks. Is that how you read that, Anthony?
Yes. Let's say they only keep people on payroll for 6 weeks versus the full 8.
Okay.
Can they still get partial forgiveness, or
yeah.
as much forgiveness as they spend on payroll?
That's my understanding. Is that I think the driver here is that if they're at that 75% of loan proceeds being used for payroll or payroll related expenses, they're going to get the forgiveness. If they're under that, that doesn't mean that there's no forgiveness. It's just going to be reduced accordingly.
Okay. This is a question we're getting a lot. What happens if I offer an employee who had their job on payroll and they refuse to come back, whether it's because they want to stay on unemployment, they got a job with Amazon or a grocery store, or people who were hiring at the time? If I can't hire someone back right now, does that impact any of my loan forgiveness? On the unemployment insurance, let me answer that one, because I've seen it in the chat room as we've talked. If someone's on unemployment and you offer them the job, that kicks them off unemployment. Now, maybe as an employee you love, I do understand that the $600 stipend from the government and unemployment, they're making more on unemployment than they might have with you directly. But from a strictly speaking, if you offer them their job back, that does kick them out of unemployment, even during these times. But what about if they just don't come back to work for me? Does that have any impact at all on my forgiveness amount, Mark?
Yeah. So I think ultimately it's going to come down to a math question, a math calculation. If you were anticipating that person being on staff as part of your calculation to come up with the loan amount, and it turns out that they're not there, or a replacement isn't there, and as such your payroll costs go below 75%, it'll be the same as what we were just talking about, that there would be some reduction in the amount that would be forgiven.
So at the end of the day, oh, sorry, Mark, I didn't mean to talk.
I was going to say probably not a lot in that case. Not a lot of reduction. Most of it would still be forgiven.
So at the end of the day, until more rules come, it's the amount spent on payroll more than some of the other things. Oh, we're losing Aaron. He's being called away. Our hour is up. But Mark, can you hang on with us?
Sure.
How long do you have, Mark? Because we've got a lot of...
probably 10 minutes.
All right. Let me get to some of the questions. Joe, what's been the most common question we've had so far in the chat room that we haven't had a chance to answer yet?
I think one of the biggest questions that you just answered was if employees were on unemployment, and you call them back. I have a lot of questions. So for the audience, if you don't know, there's been over 120 people on the line, and we've got a ton of questions here. Is there a specific category you'd like to go under?
I didn't know if you saw a question that was just repeated by a lot of people that you wanted to prioritize, or short of that, I can go back through the sections. But was there anything that really jumped out to you, Joe, as an urgent question that while we have Mark here, we'd try to get to answer?
There's a lot of questions along the how the 75% is calculated, but you guys already mentioned that we don't necessarily have the answer to that quite yet.
So on the 75%, I see Jeannie's that happen to be up there, or Jenny, sorry. My understanding back to this, Mark, the slide is right now there's no rules on specific number of FTEs. You're simply required to spend this amount on payroll to be fully forgiven. But if you don't spend this fully on payroll, but you spend something on payroll, you still can be forgiven a portion. Is that accurate?
That's what I understand, Anthony. Yes, there it would again sort of be I'm guessing some type of a pro rata reduction in forgiveness based on the amount under 75%.
Okay, so even if they only got to spend 50%, that's still there's still a portion that can be forgiven.
I'm guessing it would be at least 50%. Yeah.
Gotcha. Okay. It'd be proportional on down at this point, without further rulemaking that says otherwise.
Right.
If you spent 50%, that'd be 2/3 of what you're eligible for. So you'd be eligible for 2/3 of forgiveness, in theory.
Do owners count as a part of that payroll forgiveness portion?
If the owner is drawing a salary from the restaurant, Mark,
I believe so, and that's the way I've been advising folks, Anthony. Draw salary, other line item of owner's compensation should and could be included.
Okay. Joe, while you look for another question, I did see one on the back to the gaming question. And there was a clarification. In order to be eligible for the loan, 30% of your net gaming profit can't exceed, I'm sorry, your net gaming profit can't exceed, is it 30% or 33%?
It's actually, it's 1/3. It's 33.33.
Okay.
Yeah.
Okay. I think that answered because someone said 30 or 33. Joe, throw out another question while we have Mark still on the line.
So the average payroll costs have gone up due to the minimum wage. How is that calculated from last year? If you're trying to average things out.
Well, what I saw, Mark, if this is helpful, is the U.S. Chamber put out 3 ways to calculate the amount you're eligible for. One was to calculate all of 2019. Now, in theory, that would give you more flexibility if you had higher wages this year to get as much forgiven as possible. But if you are a newer business or you had higher payroll costs this year, you can use the first 2 months to do it, or you can look at the seasonality of your business and take your average month. So there were, Mark, is anything I just said not accurate to your point?
No, I think that there are going to be a variety of different, I mean, in practice, approaches that lenders are going to be able to use working with clients, Anthony. I think a lot of it is going to depend on the kind of documentation they have, as to what materials would be used to, validate the payroll costs. But I believe that there's flexibility built into this thing that's an inherent sort of tenet of the program. So if somebody does in fact have a different cost structure for their payroll now than what would have been reflected in last year's financial statements, I believe that they would be able to make a case talking about, and I believe that should work in the context of this program to allow that business to get optimal benefit.
So the bill gives lenders a lot of flexibility in determining how you do that if you have different circumstances than simply dividing by 12 of the year before.
I believe so.
Okay. Joe, I'm going to let you kind of keep being the main question and answer period. Oh, we lost sound. Lex, is there anything? Joe, can you hear me?
Hello, can you hear me?
I can hear you.
Okay.
Please reconnect at the top of your screen. Okay. It's not us. Is it us?
We're good. We're
I
good.
think, okay. So one
Just a
other
second.
question.
Matt, can you hear us again? M-A-T-T? Okay, we can hear it. Thank you.
All
Go ahead,
right.
Joe. What was your next question?
So next question, our SBA lender is hearing that the PPP applications are being rejected if they don't list at least 90% ownership rather than listing any and all 20+% owners as the application says.
Yeah, my understanding is that that's something that can be overridden in our application software that lenders use. It's a web-based application tool. However, what I might suggest is that lender could reach out directly to our office. Could feel free to send an email to me at mark.costello@sba.gov, and hopefully we'd be able to provide some guidance for them. It's one of those clunky things that doesn't quite, the existing system doesn't quite match up with the new program.
And one of the things that we're going to do for the team is we're writing down all the questions, and we intend to work with the SBA and the National Restaurant Association and the American Hotel and Lodging Association, as well as vendors, and get as much answered as we can. So we're going to have a rolling QA. Can you type your email into the comment box, Mark?
Sure.
We'll have a rolling Q&A that hopefully captures a lot of this as we go, and we'll do the best we can to get these questions answered. Joe, I think we have time for, we're going to go to 11:15. We have time for one, maybe two more questions. What's the next question you can select for us?
So earlier in the conversation, you guys mentioned refinancing an EIDL into a PPP. What would be the benefits of doing so?
That's a really good question. The benefit would be that, so the EIDL program was rolled out first, and so people naturally kind of started to gravitate toward that. Then the PPP program came out, and folks would naturally say, hey, wait a minute, we understand that the PPP has this debt forgiveness built into it. So that's the fundamental advantage, is that if you refinance the EIDL into the PPP, rather than having debt that would have to be repaid over 15 or 30 years, you would actually have the ability to have the entire thing forgiven.
Mary, if you could send us the Q&A, we'll get that out to the attendees and to our membership. So if you could just email Anthony at wahrestaurant.org, or excuse me, wahhospitality.org. I just dated myself.
Anthony A.
Anthony A. I'll tell you what, can you type that in for Mary there for me, Lex? On EIDL, is there different criteria to qualify for EIDL versus PPP?
You know, just a little bit. For the most part, neither of these programs are looking too much at immediate repayment ability, but the EIDL is going to look at a business's ability to repay the debt over that 15 or 30-year period. The PPP has no guarantee requirements, no personal guarantee requirements, no collateral requirements. There could be some of those things depending on the size of the EIDL loan.
Okay. Anything else on EIDL, Mark, you're hoping to get to say today, and just because of time,
Sure.
you'd like to close with?
Yeah, again, you guys, I make sure you're looking at both programs. Understand that taking one loan under one program doesn't preclude you from being able to apply for another loan under the other program. Understand that EIDL is looking out over a little bit longer time horizon, 6 months, and so you could conceivably get that 6-month working capital cushion in place at the time and ready that you're ready to relaunch your business. And also the EIDL program is available through the end of December. So that there's not the same urgency, I suppose, in terms of the application timing and the potential exhaustion of the funds.
And how long is the EIDL?
In terms,
as far as 10 years?
oh yeah, it's either going to be 15 or 30.
And
So-
the terms on those are very low on the EIDL.
3.75%. So they're looking to stretch those out as far as possible.
Okay.
All right.
Everyone, I know we didn't get to everyone's questions. We're gonna track all the questions in the chat and work with the SBA and our national partners and other experts to get them answered for you. So check our website regularly for the Q&As, or talk to your area coordinator if there's one that you're urgently trying to get answered, and they'll try to get you the answer back directly. Also, if you go to our resource guide, which is now in your screen, you will see, and Lex, I don't know if you want to share it. Lex is sharing it for you now. You will see that under this we have relief efforts, and so things around SBA loans are under federal relief. There's so much going on with this crisis. We've tried to break these into simple buckets as we can. This is also going to be a webcast, so if you think this would benefit other members of your team or your neighbors or other folks, Lex, when will this be available for people to pass on as a webcast?
By the end of the day.
By the end of the day. So look for that. We'll go from there. So we'll try to get all the questions answered and get them back out to you. Mark, thank you so much for your time. I know you're getting inundated by everyone, and it's so hard to answer when you don't know all the answers either, and everyone's looking at you. So
hey, I appreciate the opportunity. You take care.
Everyone be safe out there. Good luck. Hopefully we're back at it soon.